Welcome on board our guest, Mr. Aditya Agarwal, who is the co-founder of Wealthy, as well as Ajay Bagga. Welcome, gentlemen, on the show. Uh, Coming to you, Aditya Agarwal. So I wanted to know about the monthly expiry we have it next week. So will Nifty be able to cross that resistance level of 19,800? We have mostly been stuck in that level only. So what are you seeing next week for this?
Hi, Lisa. Hi, Shashi. Thanks for having the show. Good afternoon to all our viewers as well. I believe markets will remain choppy and range bound. I don't see markets actually crossing 19,850 to about 19,800 also on the upside in a hurry next week, especially being at an monthly expiry week. On the flip side, if I take a look at the daily time frame charts structure, it is on the verge of a breakdown from a rising channel. So 19,700 will be a very crucial support line to watch out for, and next week being a truncated week, as Srishti pointed out. So all eyes will be on the news front, what we see over the weekend and Monday, and see how Tuesday market reacts and opens. So that is important to notice, and also 19,700 on the downside will be an important level to watch out for on the buy on the Nifty, and 19,800 about 850 on the upside. If 19,850 is taken out next week somehow before Thursday, then there are chances of a big up move in the Nifty. I don't honestly see that coming through. I believe markets will continue to trade between 19,850 to about 19,700 next week as well. Something important to note will be the Bank Nifty. I believe Bank Nifty still has decent up move left in the artery, and next week we could see actually Bank Nifty outperforming Nifty, and would be surprised if 43,800 is taken out. We could be inching closer to about 44,000 on the Bank Nifty.
Okay, so those are the levels that you need to be watching out for when it comes to the Nifty 50 index. But Ajay, coming to you, and great to have you first of all on ET now. Thank you so much for your time. Ajay, how do you see India placed at this point in time? Because a couple of triggers ahead for us, especially is the election. But with respect to the global setup, with respect to China specifically, I wanted to ask, because there were reports that the growth in China could pick up, especially in the second half. But given the mysterious pneumonia outbreak, there are a lot of reports. So do you believe that it could be a concern for India as well, as we are the neighboring country? And what's the growth outlook for China that you're holding at this point?
Yeah, Shishi, China slows down further from this year. So we are expecting about 3.8, 3.9% GDP growth next year for China. The property sector issue is still huge. So yesterday, the government came out with a very belated plan, very delayed plan. And again, they are depending on the banks to shore up the property sector. That won't work out. The banks have their own issues, and for banks to do unsecured lending to a troubled property sector is really pushing all walls of credibility. Of course, these are state-owned banks, so once the orders come in, some amount of cosmetic lending will happen. But the markets became skeptical within a day. So today we saw some selling in the Chinese property sector as well, and the indices were also softish. Overall, will India benefit? Yes, we have seen some flows, but what happens is the strong dollar, the Fed peak. Normally, we see that emerging market outflows turn into inflows. So India should be a beneficiary. We have not seen that. Last 3 months. We have lost $4 billion in terms of FII outflows. We see that continuing through May because of the national elections, which you mentioned already. But the good news is that the DIIs and the retail Indian investor is picking up that slack very strongly with the SIP numbers in mutual funds and the institutional flows from EPFO and insurance. The slack is being picked up. So that won't be a source of worry for the Indian index. But we have underperformed global markets for the last 3 months, especially in November, where the MSCI global indices have done very well. India has been somewhat of a laggard to that. So there will be a catch up. Will that play out over the next 3 months leading into February? I think that's a strong possibility that you get a kind of a Santa Claus rally even in the Indian markets. And then it tapers off by Feb end as the elections are announced. March, April will be the elections. May will be the formation of the new government. Lot of volatility expected around that. So once the state elections are announced a week from now, I think the Indian markets will really take off again and breach some good levels. And then around February, we could see a taper coming in once more.
Right. So Indian market is expected to continue with that rally. But with that, let's slip into a short break. But stay tuned on the show as we get some more clarity from our guest on the show. So stay tuned on the show.
Welcome back to Your Trades on ET now, and we are discussing about the view on the market in the upcoming week, and we have Aditya as well as Ajay with us on the show today. And Aditya, coming to you and wanting to have a word on the auto stocks because they have been the top performer in the week gone by, and especially those two-wheelers, counters, a couple of passenger vehicle names have shown some resilience. But the fundamental trigger will be the auto sales data. Looks like that it's already factored in. But given the move, do you believe that maybe it's a time that all these two-wheeler counters can face some profit booking, or they're still looking that strong onto the technical front?
Srishti, I believe there is still room on the upside, especially in the two-wheeler space. Maybe not in the four-wheeler space. They've already shot up most of them. But in the two-wheeler space, I still believe there is ample room. And if you wait for the auto sales numbers, which are due to come out, they will show good numbers, I believe, because post-festive season, you usually see good numbers from especially two-wheeler space. I definitely believe there is more room on the upside. Eicher Motors, Hero Motor, both of them look very attractive to me on the charts. And higher time frame charts definitely suggest that if you invest in them and stay invested here for at least a quarter, you're going to make at least 15 to 20% gains in both of the stocks. So I'm looking at good, decent upside in Hero Moto and Eicher Motors. Sorry. And talking of commercial vehicle, yes, Ashok Leyland is also something which looks good.
Question goes to Ajay. So we have the OPEC meet next week and it has been delayed, and this is coming at a time when the oil prices are sinking. So what do you think about the oil prices going forward? Is there room for more correction?
I don't think so. Prince Abdulaziz, the Saudi foreign minister, last week had warned the shorting of the oil prices. Even now, it's at a record level, the short interest in the Brent futures market. What caused the further fall in the oil prices over the last 3 days was the postponement of the OPEC Plus meeting because the African producers are not agreeing to the Saudi proposal for holding on to production cuts. They want their new capacity to be ratified as the UAE has got ratification for its new capacity. There is excess supply because of the slowdown in Europe. We are seeing some amount of excess supply, and next year, first quarter, we are expecting some more surplus. So oil prices should stay range bound. The option with the Saudis to reduce production always stays, but they are already suffering from reducing nearly 1 billion barrel per day. The voluntary cut that they have taken. Their budget is in deficit, and just today they have borrowed about $11 billion in a syndicated loan from various banks to take care of this fiscal deficit. So there is pressure on the Saudi fiscal, but they are very clear that they want to reduce the production. The Russians will vote with the Saudis, but the Africans are not playing ball. So I would say November 30th, you will probably see status quo, which has got discounted. And post that, you could see a marginal, bid up in the oil price. But I don't see a sharp fall. That is not happening. There is no economic slowdown, which will lead to a sharp fall. Rather, it's a mildly surplus market, and it will stay so for the next 3 months.
Okay, oil expected to be range bound, but Ajay, quickly wanted to have your take on which sectors that look interesting to you at this point in time, because we have seen a couple of underperformers performing, like insurance was a sector that garnered the investors' interest. Other than that, pharma, IT, metals have been showing decent moves. So any sector that's on your radar right now?
I think specialty chemicals, that's coming back. There was a lot of dumping by the Chinese, but globally now we are seeing a recovery happening. So the theme for the first quarter could be chemicals, and within that, specialty chemicals could outperform. That's worth a look. Sugar prices are going up globally. I think we'll get some interest in the sugar sector. And the third could be cement. Government has spent 60% of its infrastructure budget already, and more will go through. And there is talk that in this winter session, the supplemental grants will ask for more infrastructure spending. And on the back of that, cement could go up, and then defense. The big order expectations on both fighter jets as well as the aircraft carrier, I think that has again brought a fresh, injected fresh interest in the manufacturing companies for that, most of which are in the public domain, in the public sector domain. I think defense is also looking good.
Yes, so specialty chemicals, cement, sugar, defense, all on Ajay's radar. So keep an eye on these sectors. But Aditya, coming to you, in this kind of market, what are the picks that you are betting on?
So I believe there is still ample room, Lisa, on several stocks. So there's stock-specific activities which are going on clearly. So if you take a look at Jubilant Foodwork, that is one stock which has clearly underperformed big time, and now it looks like it's gearing up for a big up move on the upside. So at current levels, one can actually look at accumulating Jubilant Foodwork also on declines. I'm looking at a target of 596 to about 600 on the upside with the stop loss at 515. The second stock is from the pharma space, Granules India. Look at the way that the stock has broken out from a downward sloping channel and on heavy volumes. It has done so after a long consolidation phase. So I believe the up move is here to stay in Granules. One can actually buy at current levels, also on declines again for a target of 440 on the upside with the stop loss at 355 on the downside.
Okay, so the Jubilant Food as well as Granules India looking interesting to Aditya on the stock specific ideas. But with this, we'll let you go on that. Thank you so much, Ajay and Aditya, for joining us today on ET Now, and wishing you a happy long weekend as well. But with this, we'll stay on because we are getting you the expert take, and we had a word with market veteran Sunil Kaul as well as Mark Matthews as they share which sectors they are bullish on. Listen in.
So we still like banks and the private banks as a cohort. In the banks, the loan growth continues to stay very healthy. We think margins have bottomed out. And if you put both of those together, we think banks can give you like 15 to 20% earnings growth over the next 2 to 3 years. And for some of these large banks, we think the profitability will continue to be strong. And so we still like that space overall. So we have a preference already of banks over NBFCs. And even within NBFCs, we are differentiating between the commercial focused NBFCs versus the consumer facing NBFCs, where we are underweight on, given the concern around unsecured credit.
Real estate, we would play through building materials, which also benefit from the infrastructure spend. The consumer is definitely a good story in India, which would benefit from the rising GDP per capita. Ernst & Young think that GDP per capita, which is about $2,600 today, will be $3,700 by the end of this decade. We would like to play that through the automotive sector. And then we like pharma, because it looks like the price pressure in US generics is coming to an end.
Okay, so those